There is a story everyone knows. It's about a tortoise and a hare. The hare is fast, he's confident. He knows he can beat the slow-moving tortoise, so he takes a nap. The tortoise, on the other hand, just keeps moving. He puts one foot in front of the other. He doesn't stop. He doesn't worry about the hare, he just focuses on the finish line. We all know how it ends. This isn't just a children's story, it is the single most important lesson in investing. The market is filled with hares, frantically trying to outsmart everyone else. But the winners are almost always the tortoises. Investing presents a strange paradox. The desire to get rich quick is the most common reason people end up poor. If you want to be better at something, you practice. But with investing, often the most effective action is inaction. It's about planting a seed and having the patience to let it grow into a tree, rather than digging it up every week to see if the roots are growing. True wealth isn't sprinted towards, it is patiently accumulated. Let's break down two very different ideas that sound similar. First, there is time in the market. This is the tortoise's strategy. It means you invest your money and you leave it there. You let it work for you through good times and bad. You accept ups and downs, but over years, even decades, the general direction is up. Think of yourself as a business owner. You are focused on the long-term growth of the companies you own. It's a philosophy built on patience and the power of compounding. Simple but not easy. Then there is timing the market, the hare's strategy, the belief you can predict the future. People who try to time the market attempt to sell before a crash and buy back at the bottom. It requires being right twice, once on the way out and once on the way back in. The core difference between the approaches is humility. They admit they cannot predict the future, so they don't try. Instead, they rely on the time-tested idea that economies and businesses tend to grow over time, and they diversify. They let the years do the heavy lifting. They focus on what they can control, their savings rate, their patience, their behavior. Market timers operate from supreme confidence, a dangerous mindset. Markets are complex adaptive systems, millions of people making decisions driven by hopes, fears, and goals, so they don't guess. They accept uncertainty. They diversify and let time work, their plan, savings, patience, behavior. Trying to time the market is like trying to catch the wind in a net. It feels productive, but you're just exhausting yourself. Imagine a farmer who plants a field of corn. A forecast for a dry spell makes him nervous, so he digs up all his seeds. A week later it rains, he frantically replants, then hears of pests and digs them up again. That farmer never sees a harvest. He reacts to every piece of news, every rumor, every fear. Meanwhile, the neighbor who planted, watered, and waited prospered. He had the patience to let them grow. The appeal of market timing sells control. Financial news feeds this craving. Shout doom, whisper opportunity. This cycle makes sitting still feel riskiest. But the opposite is true. Timing the market is like driving only when every light is green. You'd sit, reroute, and go nowhere. Successful long-term investors accept red lights and keep driving. Even professionals paid millions are terrible at timing. Countless studies show active funds fail to beat simple passive index funds long-term. Chasing market timing is a lottery ticket, a ghost that can't be caught. The danger of timing the market isn't just the stress and the fees, it's about the math, and the math is brutal. A huge portion of long-term gains comes from just a handful of unbelievably good days. These days often appear out of nowhere, usually in the middle of a crisis. When things feel the most terrifying, if you sit on the sidelines in cash waiting for the perfect moment, you'll almost certainly miss them. A JP Morgan study examined 2004-2023, invested $10,000 and stayed put. You'd end up with about $65,000. Miss the 10 best days, your return falls to about $32,000. Miss 20 best days and you drop to $20,000. Miss 30 and you barely make anything. The market's best days are often clustered next to its worst days. They happen when fear is at its peak and the news screams the world is ending. Think March 2020, markets plunged and then staged one of the fastest recoveries in history. Those who stayed invested recovered and made new highs. Timers were left behind, waiting for a signal that never came. They avoided pain but missed the cure. Staying invested is your ticket to participate in those best days. Without a ticket, you can't win the prize. Stay invested to avoid missing the few days that make most of the difference. There is a force some call the eighth wonder, compound interest, or in investing, compound returns. Your earnings generating their own earnings. It's like a snowball rolling down a very long hill. At first it's small and slow, then it picks up snow and grows faster and faster. The most important ingredients aren't a high start amount or a genius pick, they are time and consistency. When you time the market, you pick up your snowball and walk back to the top, interrupting compounding. You interrupt the compounding process, leave it rolling even through muddy patches, and you'll end with a boulder. Start-stop yields a handful of slush. A 25-year-old investing $300/month often out-earns a 45-year-old investing $1,000 month because of time. Earnings having babies, and those babies having babies. It's mathematical certainty. Time is the greatest asset, more valuable than intelligence or skill. The compounding machine works for you even when you are not working, while you sleep, on vacation, at work, with your family. All it asks in return is that you leave it alone. Add fuel with regular savings, then get out of the way. When we think of great investors, we picture fast-talking traders in suits. But the true legends are masters of patience, not prediction. They buy wonderful companies and hold them. Warren Buffett is the most famous example. Buy wonderful companies at fair prices, hold them, ideally forever. Our favorite holding period is forever. Buffett's wealth is a story of time, early investment, decades of holding, still invested in his 90s. Most of his fortune came after 65, compounding in its purest form. He let his snowball roll for over 80 years. Another example, Ronald Read, a janitor and gas station attendant from Vermont. He saved what little he could, invested in blue-chip stocks, reinvested dividends, and waited. He left $8 million to his local library and hospital. How? Patience. The lesson, you don't need a huge income or luck, you need the right mindset. Durable wealth is built slow. Investing is a marathon, not a sprint. They own quality assets, tune out daily noise, and let behavior determine success. Tortoises lapped hares time and time again. Repeated winners illustrate the power of time. You don't win by timing, you win by giving investments maximum time in the market. If long-term investing is so simple, why do people fail? The answer is psychology, not finance. Our brains evolved for split-second survival. The same part that sensed a lion reacts to red numbers. It screams, danger, sell. Two powerful emotions, fear and greed, drive most bad decisions. Watching your life savings shrink feels painful, even on paper. When markets soar, FOMO kicks in. You want to throw all your money into the hottest stocks. You abandon sensible strategy in a desperate attempt to catch up. This cycle makes us buy high out of greed and sell low out of fear. Financial and social media amplify emotion for clicks, turning investing into a spectator sport. Solution: build a plan during calm, rational times. A written plan is your anchor in an emotional storm. Build systems that put a barrier between emotion and money. Set up automatic transfers from your bank every month. Dollar-cost averaging forces consistent investing whether markets are up or down. It removes emotion from the process. Automating your investments makes you follow the plan. Set the system, automate transfers, and remove emotion from the wheel. So, how do you become a tortoise? First, start now. Don't wait for the perfect time. The second best time is today. Start with whatever you can afford. Even $50/month. The habit is more important than the amount at first. Second, embrace simplicity. You don't need to pick winners. Invest in low-cost, broadly diversified index funds or ETFs. These funds own hundreds or thousands of companies. Instant diversification. Don't put all eggs in one basket. Prefer cheap funds. Expense ratio matters. Third, automate. Set recurring transfers. That's dollar-cost averaging. Automation forces you to buy low without thinking. Learn to love boredom. Successful investing should be boring. If you check daily and feel excitement or fear, you're doing it wrong. Find excitement elsewhere. Focus on career, family, hobbies. Let your money work in the background. The less you tinker, the better your results. Start now, automate, diversify, and embrace the boring path to long-term wealth. We started with the tortoise and the hare. The market is full of hares chasing short-term wins. Tortoises keep going. They win by not stopping. Harness compounding and time. Discipline, not genius. Patience, not prediction. Control what you can. Your behavior. Tune out the noise and ignore the crowd. Stick to your plan when instinct screams otherwise. Have the humility to admit you don't know the future and the wisdom to not try. Have faith in the long-term arc of human progress and economic growth. The race is long. There will be good years and terrible years, euphoria and despair. The hare will try to sell you new strategies and get rich-quick ads. Ignore him. Your goal is simply to cross the finish line. Put one foot in front of the other. Save consistently. Stay invested. Let time do the rest. That is the secret. Available to everyone. That is how you win. Be the tortoise. The race is long. It can be yours to win.